In the space of universal life insurance, we find that there is a lot of confusion. Oftentimes, clients will come in, they might talk about, oh, I have a whole life policy, and we dig in, it's actually a universal life policy. But inside of universal life, there's also distinctions between indexed and variable and guaranteed. And so today we're going to get into a few distinctions on the difference between a standard universal life policy and an index universal life policy. So if we look at Investopedia's definition of a universal life insurance policy is one that's a permanent life insurance policy, meaning it should last the lifetime of the insured, that has a investment savings element, low premium similar to those of term life insurance. Most universal life policies contain flexible premiums. However, some require single premiums and others require a fixed premium, right? So what does that mean, right? Single premium is something that you would just make one payment into, and now you own life insurance for potentially the rest of your life. Whereas a fixed premium, you're paying every single year. And as we started off saying that, they have lower premiums, those similar to term, I like to think of universal life insurance, especially the guaranteed universal life insurance, as permanent term insurance. The idea there is you're going to pay money into this for the lifetime of that contract. And as long as you keep paying those premiums, the insurance company is going to guarantee you a death benefit. There's really no savings component that's built up in those policies, but they're guaranteed not to lapse so long as you're making your premium payments. They're not as cheap as term because, as you can imagine, they're going to be in place forever. So yeah, it might be lower cost, but part of that low cost comes along with no savings component. So really, when you start to look at these things, it's like, well, if I'm going to be putting extra premium in to have a guaranteed death benefit, do I want something that can grow? Do I want something that has cash value in it? And so in that space, traditional guaranteed universal life insurance doesn't fit that bill if you're looking for more than just death benefit. To continue on the track of universal life insurance, I think the thing that really distinguishes it from the other types of universal life insurance is the fact that any savings component is tied to interest rates. And the crediting being tied to interest rates, in the last 10 years, interest rates have done nothing but go down. So it's been a real challenge for insurance companies and the policy owners who have these policies to gain any sort of interest rate credit and to really build any sort of cash value in that savings component. So now let's get into what is an index universal life insurance policy. So according to Investopedia, universal life insurance comes with a lot of different flavors. Those are fixed rate models like we just talked about, variables, which we won't really discuss in this video, but also the index type, where you're getting interest rate crediting based on an index, but your money's not really in the market, right? It's just credited as if it was tracking that index. So what does that mean? Insurance allows for owners to allocate cash values in the amounts either fixed or equity indexes. Policies offer well-known indexes such as the S&P 500, and IUL policies are far more volatile than, say, a fixed policy, but less risky than a variable policy because, like I said before, your money's not actually invested in an index. I think that when it comes to the index universal life policy, these came about as an answer to why I can't get interest rate credit in a traditional universal life policy, right? When you start building in these different indexes and now your money that's going in is being credited based on that, in the last, say, 10 years, those indexes have looked really good. And while there's a floor generally of 0%, meaning you're not going to lose any money in a given year, if those indexes are below 0, that means your interest rate credit for that year is 0. The other thing that comes into universal life indexed versus a fixed is the fact that there's a lot of moving parts and a lot of mechanics to it. So cost of insurance is changing every year. Premiums can change. They're flexible. You can put more in, you can put less in. And unfortunately, when people are left to their own devices of minimum funding versus target funding versus overfunding, they usually err on the side of minimum, which creates a lot of challenges further down the road because of insurance costs. So the things that they have in common now are the fact that they're meant to be lifetime policies. You're meant to fund them for a specific period of time that you choose. There's flexibility in the funding of those policies, but where they really differ is in the way interest rates credited and the way cash accumulates inside of them, and if you can or can't borrow from those policies. Now you're probably asking yourself, well, what is the best for me, right? And that requires a deeper conversation for us to really understand where you are in your financial journey, what pieces you already have in place, and what pieces can be best implemented for where you want to get to. So in order to have that conversation, what you can do is click in the box below, click the link. One of the Epic team members will reach out to you, and they can really get you started on this path or help you implement where you already have some pieces in place. Again, if you like this video, please go ahead and give it a like. Hit that subscribe button because we're putting out content like this every single day.